So I want to talk about a little bit about exam one, and how we go on from here. Um, exam one was sort of a all over the place test, honestly. I could tell, there are some people who are definitely on board, engaging in the materials, definitely doing the work, getting it done. But then there are also those who are not. Some who it looks like, I couldn't imagine that problems were being done. And so grades kind of went all over the place. It's definitely not something that is impossible to do. There were definitely some grades that were very impressive, A's even without any curve or any sort of alteration at all. There were B's, C's, but there are just some people who aren't doing work. And honestly, it's not going to work that way. I think we can tell this. Now, there are a couple of things that I want to alert you to. I do plan on having a bonus assignment that you can work through. This is to earn a curve. I just don't believe in giving points without some amount of work on your end, especially in a distribution where it's so spread out that I can't even understand how hard the test was or if it deserves the natural curve. I want you to be able to do some work and give me some effort into the areas that were not working for you to make it better, right? So there will be that opportunity. Keep your eyes open. I will likely post it this evening or tomorrow, and then it'll be due like in a week, right? Um, and I also really, at this point, if you've made below a 60 on this exam and you do not immediately reach out to me and let's start talking about it, let's go over, make an appointment for you and I to go over that exam together and talk through it. um it's not going to happen. I can tell you that right now. The worst thing you can do is put in the same amount of effort that you put in this exam into the next exam and then expect something different to happen. Not going to happen. If this is your first time in this course, one thing that I often have to coach people on after the first exam, face to face and online, is to start thinking more deeply than you did in your intro to financial course. So that first course, for us, for Sam, if you took it at Sam, it's accounting 2301. We are going deeper into the material. If that was not very clear from, the notes and the questions and the concepts I was talking about, we need you to have a deeper understanding of this. It might have been a little bit uh, falsely soothing to see, oh, yeah, I remember the prepaid asset account. Sure, I've got this. Make sure, if you have that feeling, make sure you're applying it on a few of the things, a few of the chapter study problems that I write, and that you really do understand it before you sort of just mentally tick it off as something you've mastered, okay? Because we really need you to go deep. If you only did Alex and thought, hey, that was enough for this exam, and then maybe you breeze through the assignment one, connect, and you're like, oh, I've got this. Again, that's not enough. I've emphasized time and again, you really need to go through those chapter study problems. Um, and quite honestly, though the problems that were on the exam weren't random questions. At least, by and large, we'll go over it in a second, but the three workout problems that were 70 points of the entire exam, um, I featured in videos in some format or another. I, discussed them during Zoom hours. I put stuff out there and suggested problems for you to work and said, especially these ones. There's a reason why I'm honing in on certain things and belaboring them in additional videos. And you might think, wow, that's just too many videos to watch. I got this playlist of videos, and then you're making more videos covering problems that you're working. Understand that, remember, in my face-to-face class, they have to watch those playlist of videos too. Like, I don't cover my notes in a face-to-face class. So that's something they're responsible for outside of class. Then they also do tend to watch a lot of those problem videos too, because I can't cover all the problems in class. Mostly my class time is about working problems, getting questions, answering questions. And again, that's kind of what I want these Zoom hours to be. No one's really forthcoming with questions. That's okay. But you got to understand that since you're taking this online, there's at least 3 hours a week of material that substitutes for you not having a class. So that's why there are so many videos that are so important to watch. All right. So with all that said, I do want to dive into specifics. I do want to look at the test. And I have it printed in a hard copy. So there's also, and I'm going to pause here for a moment to allow the people that thankfully came today to retrieve it if they want to. But it is on our course Blackboard page. I just uploaded it right before this meeting. It's under the exam one preparation materials, and it just says exam one document, and it's after the link to take the Respondus test. So I'll pause for a moment here, then let you guys get that if you want to. So I'm going to switch over to my document camera with that document printed and just talk about the the exam problems. Give some idea of like, okay, how did I expect you to be prepared for this? Or perhaps bring it back to something that you were exposed to so that you can kind of connect the dots and really remember, above all, remember, this is a class with a cumulative final. And that cumulative final can, and for most students, in my experience, usually does replace a low test grade. You do need to take a little additional responsibility to make sure that after we're done with the test, you don't just sort of disregard it as finished business. Because not only does this material in particular really help you navigate the material that's coming down the pipeline, it also is going to appear again, right? All right, so let's jump in. I just basically put all the questions into a Word document. There might be minor wording changes, but the spirit of the questions are all the same. The very first question actually was one that I hesitated putting on the exam because I hadn't really expressed the importance of the economic entity assumption, but but it wasn't an issue. Most people got this right. In fact, it was flagged as a question that was not discriminatory, meaning that people who overall performed poorly, tended to get this one right. Right. So Sally, this one, I really don't even know if I have to go over it, but yeah, she's putting her personal mortgage and listing it as a business expense. And so she's blurring the lines between who she is in the world and as a business owner, right? We can't do that. It would be as bad as if she put her personal mortgage payable on the balance sheet of her business. And so that's not allowed. And this is just a simple definition, or I should say, an application of a definition. If you knew that that's not allowed and then you knew the idea behind it, that would be okay. And number two follows in the same idea. It's the application of a principle. It's the application of the expense recognition principle. So, we have this transaction where we borrowed money for a machine to pay for that machine. We borrowed $30,000. We're going to pay the $30,000 back in cash in 2 years, but we're using the machine for 3 years. And so, how do we expense this? And remember that the matching principle tells me, or the expense recognition is the more formal name, or is the only formal name. They took away matching. I have no idea why. They didn't like the word matching, but the FASB got a little bit, I guess, persnickety on us and said no more matching. I still think it's a brilliant way of describing it, so I use it. So this is what's going to guide our thoughts here. Remember what the matching principle says, and this is something, oh man, I emphasized 20 times and will continue to emphasize throughout the course because it is so paramount in why we recognize expenses the way we do in an accounting system. Under US GAAP, the matching principle tells me that I want to recognize expenses in the years that they help generate revenue for that year. So if I'm going to use the machine for 3 years in my core operations, those are the years that it will help generate revenue. So then I want to take this $30,000 and spread it over those 3 years. So putting it all in 1 year is a bad idea. That's not matching to years 2 and 3. Waiting until we've sold the machine is a little out of the question because we didn't buy it just to sell it. That's not part of our revenue generation. The machine is to help us generate revenues, not by virtue of it being, for example, like inventory. Allocate this over the machine's useful life. All right, yep, that's C, sounds good. Recognize the expense for the machine when the note is paid off in 2 years. That's what cash accounting would do, but we're looking for accrual accounting and the matching principle, right? So that is going to be this one here. This next one is the revenue recognition principle. Again, another principle that I beat into the ground. I don't beat this one as hard as I do the matching principle because people tend to get it more often than not. Eventually, pretty quickly that there are, two criteria. We got to earn the revenue by discharging our our obligations, providing goods or services. And also, we have a reasonable expectation of payment. And I mentioned that, hey, if we've invoiced someone or billed someone, that means we have a reasonable expectation of payment. We're not worried about, bad debts at this point. That doesn't that doesn't keep me from recording revenue. Because yeah, some people won't be able to pay, but the key is a reasonable expectation of payment. And it's reasonable to expect that if I've provided goods or services to somebody, they are going to pay me. Right? And that's theft of services. So we can actually legally go after them if they don't. So we receive on December 20th, they order and pay, right? So they're paying in advance, but we're not delivering until January. So when the payment's received, we have obviously the reasonable expectation of payment in hand, but we haven't earned the revenue yet because we haven't delivered anything. When we purchase materials for the order, when that has nothing to do with us, right? I mean, that has nothing to do with it gets us on the way to earning, but we haven't earned it yet. It's a step to building it, whatever, right? In January, when the furniture is delivered, okay, yeah, because by January I have both the payment and I'm providing the good in this case. The invoice is generated. No, not just the invoice, right? The invoice is fine if I've already provided the good or service, but I haven't, I can't even tell when it was generated. That's kind of a red herring answer because it doesn't even mention an invoice up here. But it would be when both of the conditions of the revenue recognition criteria are met, or in January. Number four is a peer definition, and it's asking you to describe the difference between an expense and a loss. right? Chapter one notes go and define losses, expenses. I got a battery of these, a gain and a revenue, an expense and a dividend. So there's a lot of these questions about picking apart the definitions and understanding what the difference is. So an expense and a loss, they are both transactions that reduce net assets. So both of these reduce net assets. Remember, net assets equity is also just A minus L. So, and they do that by either reducing A or increasing L. So that's true for both expenses and losses. What is different between those is expenses are within the core operations of the company. So the day to day, right, what the company is in the business of doing, selling products, providing services. Losses are not in the core operations of the company. So, for example, I am a coffee vendor and I'm Starbucks. I'm selling coffee. That's part of my core operations. But offloading an outdated espresso machine by selling it, that's not in my core operations. So whether I get profit or I take a loss on that sale, it's not an expense or a revenue, it's a gain or a loss. And those are very important distinctions when we're trying to decide, is this going to happen again, right? And accounting information is used not only to evaluate the present, but to forecast the future. And so this discrepancy between whether something is a day after day because it's within the company's core operations, or if it occurs infrequently, is very front and center for users' attention. Like, holy crap, there was $1 million loss. Well, don't worry, because it's a loss, it's going to occur infrequently. So I don't expect that $1 million to be something I see quarter after quarter or year after year. So above, really, all definitions, all from your notes. A lot of my multiple choice will be conceptual or definition based. Um, and because I want you to know what you're doing, I don't want you just working problems until your eyes bleed and not really understand what you're doing. All right. On number five, six, right? So there was one that had, there are two questions that had a lot of information with them, and you had to do some calculations. This is our first calculation question. It's telling me about the assets, liabilities, and the equity and the retained earnings of the company. And it said that we had the fall, which at 12/31/23, the company reported the following assets, liabilities, capital stock. Notice the only thing I didn't tell you about is the retained earnings, and they declared dividends of 200. So this one, there's a lot of chapter one study problems, or like four or five, I think. At least there's at least four of these sort of working out the accounting equation. I'll just call it common stock. It does have a few names, all used in the different problems, plus retained earnings. So this is basically what I'm testing your knowledge on in this question. And there's a status quo at 1/1 that says I have $1 million of assets, that I have $625,000 of liabilities, um, contributed capital, which is common stock of 100,000, and then retained earnings of 275. So that's at the beginning of the year. Then at the end of the year, 12/31, things have changed. I have $1.5 million of assets. I have $750,000 of liabilities. And then capital stock, which I switched on the test, I believe, to common stock because capital is kind of a older older person's term, I guess, term of decades past. And then, but I don't give you final retained earnings. Now, the first question I ask is, what is this final retained earnings? Well, you have the equation right here. You just have to solve for it. Altogether, this is 1,050,000. Subtract it from 1.5 million, and that would give you 450,000. And the next question, which deals with the same company, asks for the company's net income or loss. Now, this tends to be the part that can confuse people if they haven't worked a few of these problems before to understand that balance sheet data, assets, liabilities, common stock, equity accounts, like retained earnings, are only true at a date in time or a moment in time, really. And so we have a moment in time here and a moment in time here. Now, dividends do not happen in a moment in time, and neither does net income. And that's because dividends and net income are what track the transition between 275 and our ending retained earnings, which we found to be equal to $450,000. And so what we need here is the net income that I got for the period. And then information about dividends. Well, it says I paid dividends of 200,000. I know that that reduces my retained earnings. And then it just becomes an issue of solving for retained earnings at the end of the year, given that we have this vertical formula that explains the change of retained earnings. So moving the 200 to the other side gives me 650. Subtracting the 275 would give me $375,000 of netting when we solve that equation. So for those types of problems, it's really testing whether you understand the difference between this balance sheet information and how it's true at a moment in time versus the things that happened over this year, right? This is what happened over the year. We made net income, we paid dividends. Now, there were tons of things that happened here between assets at 1/1 and assets at 12/31, liabilities at 1 beginning and end of the year, common stock at the beginning and end of the year, right? I will say that basically there are tons of things that could have happened here and tons of things that can happen here. Retained earnings, there is very little at this point in our knowledge of retained earnings, and not up until the end of the semester will we even contemplate anything else that could happen to retained earnings. Those are the only two things that happen to retained earnings over the year, net income and dividends, as they are closed into it. All right. Number seven, again, we're back to concepts. Adjusting entries will impact. Now, you might be like, well, crap, how the hell would I ever figure this out? In chapter two, notes, there's a long warm up to adjusting entries that talk about how they will always affect an income statement account because what adjusting entries represent are applications. Actually, I didn't need to do that. Applications of revenue and expense recognition. So, I mean, we are making journal entries when the business is closed, right? So, this is not us interacting with customers. Cash is never a part of an adjusting entry. We are recognizing revenues and expenses that would not have been recognized until we force them in as accountants and make the adjusting entry. Now, the other piece of this comes from the fact that every revenue and every expense, again, something that I talked about in a Zoom hour and also in the definitions, revenues are increases to net assets by increasing an asset or reducing a liability. Okay. Same thing for expenses, except it's just the opposite. They're reductions to net assets by reducing assets or increasing liabilities. So anytime I recognize a revenue, I either have to increase an asset or reduce a liability. Anytime I recognize an expense, I have to reduce an asset or increase a liability, right? So that means I have an income statement item and assets and liabilities. What are those? Balance sheet items. So they are changes to the balance sheet and the income statement and never anything else. If you didn't cap catch this part, um, in my chapter two lecture, well, then maybe you did enough problems that you saw, well, I'm always, when I'm noting the effect of my debit or credit accounts, I am always increasing or decreasing net income. And at least that would steer you away from the balance sheet and A and D, at least, there would be a process of elimination at some point that hopefully you could figure it out. But the real core concept I'm looking at here is there's always an income statement. And because there's always income statement, that means that there has to be a balance sheet effect, right? It's a very strong relationship between income statement and balance sheet. Which of the following are not true about adjusting entries? They exist in both cash basis and accrual basis systems. Well, one of the big rules I said about adjusting entries is they never involve cash. So there's no way that they would be in a cash basis system. So that's not true. But let's make sure that that's the only thing that's not true, right? They result exclusively from applications of matching and revenue recognition principles. Here we go. Yep, that's right. They never involve cash accounts and talked about that. And they are made at the end of each reporting period to provide faithfully representative financial reports. This is also true. So these three are true, but these just they cannot be under a cash basis system because they don't involve cash account. Um, a bookkeeper, okay, here's an accounting error. They mistakenly record the receipt of cash for 2 year subscriptions. And so we receive cash, right, for 2 year subscriptions and a debit to cash and a credit to subscription revenue. So what they did was cash, subscription revenue, and this is a 2 year contract to provide subscription to our service, to our customers. If the company utilizes accrual accounting and no adjustment is made to correct this, which of the following appropriately states the issues going on? All right, so the question becomes, what should we? This is what we did. And what should we have done? Well, we should have, according to the revenue recognition principle, yes, we do recognize the cash. Cash tends to not be an error, okay? Because unless there's fraud going on or just a true miscounting of cash, or misentering of cash in the system, we can verify cash. So we're not likely to record too much cash or too little cash like we are. It's much more likely we're going to record too much or too little revenue. But in this case, we can't record any revenue until we start doing the work, and it's all deferred revenue instead. And so instead of recognizing an asset and all of the net income immediately, we should have recognized the asset and an obligation to provide subscription services to our customers. As we do that, then we would have an adjusting entry that would reduce my liability, less deferred revenue, and I could recognize some sales revenue. Okay. This is only as it's earned. So unless we earned it all, which we can't because we're providing these over 2 years, at the end of the year, what's missing? Well, this deferred revenue account would still be there. And I'm not going to be able to recognize all of the subscription revenue like I did. I'll only be able to recognize the part that I've earned, which is going to be less than 2 years because we have to report, at least every year. And so we have recognized too much revenue and not enough liability. The too much revenue because we recorded every dollar of cash as revenue when we should have only recorded revenue for what we've actually earned. And then the liability that is not even present here, that we have an obligation to provide more subscriptions. So we had too much revenue. That means we overstated our net income and not enough liability. That means we understated our liabilities. So I would take that first and then see what you can eliminate. Okay. Liabilities understated, that clears. Liabilities overstated, that does not clear. Liabilities no effect, that's not true. Liabilities overstated, that clears. Liabilities understated, oop, that clears. Oops, sorry. D does not clear. Overstated does not clear. Understated does clear. All right, so now we're down between A and E. Let's look at net income. It says net income was overstated in A, net income was overstated in E. Okay, not getting any difference there. Both of them say equity was overstated. Yes, that's true. If net income at the end of a first year, net income and equity share that same error, both in magnitude and direction. So they will both be overstated by the same amount in this example. The only thing that is different between A and E is whether assets are overstated or not. Now, cash is the only asset I see here. And it would not be over or understated because all I'm doing is recording the amount of cash as subscription revenue versus recording that cash as a liability. But I don't have a discrepancy between the amounts of cash. So it would have to be E. No effect to assets, but liabilities are understated, net income is overstated, and equity is overstated. Because and the reason, remember, the reason there's this connection between net income and equity is because we close all the net income accounts and we close them into retained earnings. And so that retained earnings account, which is an equity account, basically brings in all of that error in the first year. All right. And the final one, definitely one of the most missed questions. Overall, we really need to think about cash versus accrual accounting. And it was Zoom hours that I talked about it the most, but you had examples of problems, you had McGraw-Hill problems, um, and it was in your notes, it was at the end of the chapter one notes, but I made a whole 2 days of Zoom hours about cash versus accrual accounting, and don't think I'm that professor that's going to sit there and talk about something for 2 days or two whole sessions and not put it on a test. I'm not looking for a footnote to stump you. I'm trying to emphasize and talk about the things I want you to know, and therefore will test you on those as well. So, what's the difference between cash and accrual accounting? The conditions under which each system recognizes inflows and outflows of cash. So do we not debit cash in the cash basis, but we do? No. Going back to the fundamental difference, it's about when we recognize revenues and expenses. All right, so this one is not right. Whether revenues and expenses are recognized at all in the system, that's patently false. They both recognize revenues and expenses. They just do it under different conditions. The conditions under which expenses and revenues are recognized, that sounds right. Whether cash transactions are recognized at all sounds a little bit, yeah. Just be careful. Be careful with extremes, right? Um, like whether I do this at all or not. If you're about to select an extreme, you better be damn sure it's the right answer. Okay. Extremes, that's a general test taking tip. I used to teach at Princeton Review. So we tell students all the time, the more extreme the answer is on the LSAT, SAT, PSAT, whatever the hell you're taking, the less likely it is to be correct. All else equal. And in this case, yes. We recognize revenues and expenses under a cash system when cash is paid or received. Under an accrual system, we have the revenue recognition principle and the expense recognition principle to guide us. Right. So that is the multiple choice portion of the exam. And like I said, you're not likely going to see much of a deviation in terms of there being a lot of conceptual stuff on there. A lot, you know, it gets a little harder to draw out in the material on exams 2 and 3, but there's enough there still that I can really still test concepts, and I like to because it's hard to test them in written problems. So I like to do that on the multiple choice. There will always be a few calculations as well, but you can expect that to be the way it proceeds for the most part. So